Mr. or Mrs. Entrepreneur, are you making major retirement planning mistakes? If so, why are you doing it again and again and again? Hi there, my name is Kenneth French. I'm the author of The Entrepreneur's Manifesto, a collection of smart financial advice, and I've been asked to do this podcast concerning exactly that, major retirement planning mistakes that entrepreneurs make. I've been writing for a number of years. This is my second book. I have a third one coming out in about 6 months. And hopefully we will take just a few minutes and you will understand exactly what it is so many people are doing, so many entrepreneurs are doing in the way of mistakes, getting in the way of their retirement plan. Hopefully you won't be one of these people who's doing this in the future. Much is out there about the classic financial mistakes that plague startups, family businesses, corporations, and charities. Aside from these blunders, some financial mistakes, they're plaguing retirees as well. I guess calling them mistakes is a bit harsh. Not all of them represent real errors in judgment, lack of knowledge. Yet whether they're a result from ignorance or fate, or we need to be aware for them and plan for them. Leaving work too early, leaving the workforce too early. Social Security benefits rise, about 8% every year. You delay receiving them. Waiting a few years to apply the benefit can position you for a higher retirement income. Filing for your monthly benefit before you reach Social Security full retirement age, or FRA as they call it, can mean comparatively smaller monthly payments. Meanwhile, you can delay claiming Social Security, that positions you for more significant monthly benefits down the road. Understanding medical bills, or I should say underestimating medical bills. In its latest estimate of retiree health costs, the Center of Retirement Research at Boston College said that the average retiree will need at least $4,300, that's $4,300 per year to pay for future healthcare costs. Medicare will not pay for everything. That whatever it was, $4,300 represents out-of-pocket costs, which includes dental, vision, and long-term care. Taking the potential for longevity too lightly is an issue. Actuaries at the SSA, or Social Security Administration, project that around a third of today's 65-year-olds will live to age 90, with about 1 in 7 living 95 years or longer. The prospect of a 20 to 30-year retirement is not all unreasonable, yet there is still a lingering cultural assumption that our retirement might duplicate the relatively short ones of, those past. Withdrawing too much per year, by the way. You may have heard that, the 4% rule, a guideline stating that you should take out only about 4% of your annual savings a year. Many times, you try to abide by it, but it's tough. So why do others withdraw 7 and 8% per year? In the first phase of retirement, people tend to live it up. Really live it up. More free time naturally promotes new ventures and travel and inclination to live a little bit more lavishly. Ignoring tax inefficiency and efficient fees, it can be a good idea to have both taxable and tax advantage accounts in retirement. Assuming your retirement will be long, you may want to assign this or that investment to a kind of a preferred domain. What does that mean? It means the taxable or tax advantage account that may be most appropriate for it to pursue a better after-tax rate of return for the entire portfolio. Now, many younger investors chase returns. That's an issue. Some retirees, however, find a shortfall when they try to live on a portfolio income. In response, they move money into stocks offering significant dividends or high-yield bonds, something you might regret in the long run. Depends on the circumstance, obviously. Now, taking retirement income off both the principal and interest of a portfolio may give way to reduce, what would you think it would do? It would reduce potentially the potential of ordinary income and income taxes. Now, one thing to consider is you need to avoid market risk. Equity investment does invite risk, but the reward may just in fact be worth it. In contrast, many fixed-rate investments offer comparatively small yields nowadays, especially in the coronavirus time and era. retiring with a heavier debt. It is hard to preserve or accumulate wealth when you're handling portions of it to creditors, people that you owe money to. Putting college costs before retirement costs is yet another one. There is no financial aid program for retirement. There is no retirement loans or something like that. There are no such thing. Your children have their whole financial lives ahead of them. Try to refrain from touching your home equity or giving them money from your IRA, et cetera, for educational expenses, as they potentially can take loans or get financing or grants, etc. And finally, retiring with no plan or investment strategy. As unplanned, retirement may bring terrible financial surprises. The absence of a strategy can leave people prone to market timing and day trading. So, we've gone over some classic retirement planning mistakes. Hopefully you're not making them, or now that you've heard some of these, maybe you won't have to worry about them because you've already got them in your back pocket and you have them in your thought process. If you need more information about us, about me, about the book, please check us out on the web at www.vastsolutionsgroup.com, or you can give us a call at 888-808-8278. Or you can go to Amazon or any book retailer for my book. Once again, my name, Kenner French. I wrote The Entrepreneur's Manifesto, a collection of smart financial advice. I'd love it if you took a gander in the book, and if it added value, please get in touch. I would love to hear about it. And or tell your friends about the book, this audio, etc. Thanks for taking the time, and hopefully it's added value in some shape or form. Thank you.